Welcome to the Explainer. Listen, we need to talk about the May 5th, 2026 Commitments of Traders report for the gold market. Because what's unfolding right now is, honestly, it's pretty extraordinary. I gotta be upfront with you. This data, it does not paint the picture of a healthy market. What we're actually looking at is a highly dangerous, historically extreme inflection point. If you're holding gold, trading gold, or even just thinking about it, you are standing on the edge of a massive market event.
Okay, let's dive right into this. The executive summary of this report drops a really heavy phrase, a generational standoff. We aren't just parsing through your run-of-the-mill weekly data here. We're witnessing a massive, escalating confrontation between opposing, historically powerful market forces. The tension in this market is wound so incredibly tight that its resolution simply cannot be orderly. It's going to be violent.
Here's our roadmap for this explainer. We'll start with this generational market standoff, then look at the clash of titans driving it and how retail is being set up as exit liquidity. After that, we're benchmarking against the 2020 cycle, running through the May 5th trigger failures, and finally laying out a tactical capital preservation guide.
So, part one, a generational market standoff. The battlefield is set.
Right now, the market is severely imbalanced. That false start pullback we saw last week, instead of shaking out the excess, it actually sucked in even more speculative momentum. The market is leaning way more precariously than it was before. Which brings us to this massive number, 179,823. That is the total net short contracts held by the swap dealers, basically the giant bullion banks. They completely reverse their bullish covering from the week prior, stacking on over 5,000 new short contracts. To put that into perspective for you, this is an 8.5% increase over the absolute extreme benchmarks we saw back in 2020. This isn't just high, it's a generational anomaly. And look at the sheer scale of their market dominance. These giant bullion banks hold a staggering 56.3% of the entire market short open interest, the total number of outstanding active trades. They're sitting on over 200,000 individual short contracts. They're definitely not passive participants here. They're acting as the active, aggressive seller of last resort. Whenever speculative buyers stampede into the market, the banks step right in front of them, rebuilding this massive wall of resistance.
Which brings us to part two, the clash of titans, banks versus hedge funds. So if the banks are building a wall, who's charging at it? This brilliantly illustrates the confrontation driving all the current gold market volatility. On one side, you've got the immovable object, the swap dealer banks wielding the financial firepower to just cap any rally and absolutely crush prices in the near term. On the exact opposite side, we have the irresistible force, managed money, the trend-following hedge funds who just aggressively added 4,502 new long contracts. It's a heavily armored bank wall standing right in the path of fickle trend-chasing hedge funds, jumping into a dangerously lopsided trade. And man, lopsided is absolutely the operative word here. 94,254. That's the net long position of those hedge funds. Their longs are outnumbering their shorts by 4.2 to 1. It's like everyone is rushing to the exact same side of a boat that's already taking on water. This massive number is essentially a tinderbox of concentrated bullishness. History has shown us for the past 5 years that whenever managed money gets this stretched, it consistently marks the end of rallies and ignites a sudden, brutal liquidation event. They're the fuel for the coming fire. Moving to part three, retail as exit liquidity. The trap is sprung. You know, when titans clash like this, everyday traders usually end up as collateral damage in what we call the retail trader trap. Retail traders, classified as non-reportables in the data, are currently net long by 35,662 contracts, and they are stubbornly holding on, with a long-to-short ratio sitting at 3.6 to 1. As a risk-focused analyst, I have to tell you, this is a classic late-cycle top indicator. Significant market bottoms just do not form when retail is this heavy and aggressive on the long side. I cannot stress this enough. They are unwittingly acting as the primary target and exit liquidity for the institutions. They are setting themselves up as fuel for a final capitulation washout. And this is perfectly confirmed when we check in on what the actual smart money is doing. The long-term institutional investors, the other reportables who buy gold as a core asset, are completely flat. Their positions basically didn't twitch at all this week. They're just sitting on the sidelines, watching this chaos unfold. That total inaction, it tells us everything we need to know. This late-stage rally is built on highly unstable speculative momentum, not conviction-based institutional accumulation. The smart money knows to stay completely out of the way.
Part 4. Benchmarking the 2020 cycle, the prophecy.
Let's move to history and see how this builds. Because to truly grasp what's coming next, we have to look back. These bank extremes don't happen often, but when they do, the outcomes are incredibly predictable. Over the last decade, extreme bank shorts have preceded incredible market moves. In July 2016 and post-October 2018, massive bank short positions marked major market lows that launched powerful, sustained rallies. Then we hit August 2020, our benchmark, where bank shorts hit a staggering 165,678 contracts. What happened next? A brutal $400 correction that absolutely crushed the hedge fund longs, forcing them from over 150,000 contracts down to under 50,000. But once that flush was complete, the bank's massive short position became the engine for a huge short squeeze rally. Today, remember, we're sitting at almost 180,000 bank shorts. The historical prophecy here is a crash followed by a generational boom.
Which takes us to part 5, May 5 trigger failures, the diagnostics. So if we know a crash is coming, how on earth do we know when it's safe to enter? Well, we use a mathematical roadmap, but right now, as of May 5th, every single trigger condition for a safe entry point has failed. We need hedge fund net longs to drop below 70,000 to show the excess is flushed out. Instead, they climb to over 94,000, moving further away from safety. Bank shorts need to drop below 165,000. Nope, they climb to almost 180,000. Retail needs to capitulate below 25,000 longs. Failed again, they actually bought more. And finally, open interest is falling, which means there's no new money entering to sustain this uptrend. It's just a hollow, momentum-driven shell. The market is structurally way more dangerous today than it was a week ago. The washout is imminent, and it is definitely not complete.
Finally, Part 6, Tactical Capital Preservation Guide, the actionable mandate. Of course, all this analysis is useless unless we actually take action based on it. So here is your actionable mandate for the coming weeks, and it requires absolute institutional discipline. Step 1, stay in cash. Seriously, do not stand in front of this probable crash. The path of least resistance right now is a sharp, sudden downward flush. Just let the banks and the hedge funds destroy each other. Step 2, exercise absolute patience. We're waiting for the weekly reports to show that managed money longs have cliff dropped back toward that 70,000 level. That is a mathematical necessity before a bull market can resume. And step 3, once that speculative flush is complete and the washout has occurred, that's your signal. The banks will be forced to cover their historic anomaly of shorts, and you step in to buy the ensuing generational short squeeze rally. We've laid out all the data. The battle lines between the banks and the hedge funds are drawn at absolute historic extremes. A painful washout of speculative longs isn't just a possibility anymore. It's a mathematical necessity. So I'll leave you with this final thought. When the violent washout finally hits, will you be the exit liquidity caught holding the bag? Or will you exercise absolute patience, stand aside with the smart money, and wait to buy the ashes for the generational opportunity that follows? The choice is entirely up to you. Thank you for joining me for this explainer. Keep your eyes on the data and stay safe out there.